Speaker for this afternoon. Mauro, you've been so brave to take this spot just before the last plenary session. And you will be talking about, actually it's one of my favorite subjects here, again coming from the consultancy world and in an audit firm, to work together, the work together between actuaries and accountants. I find that's an IFRS 17 discipline that is very, very important. So please go ahead.
Thank you, Christopher. And so, I mean, this is the, let's say, this is a smaller circle, right? So, I mean, guys, why don't you come over a little bit closer to here? Because like, it's going to be easier to discuss. Like, come a little bit closer. So let's try to have some fun as well, right? In the next 20 minutes. This is the second last, I think, session that we're going to have in this 2024 European Congress of Actuaries. So let's start with maybe just a quick question. Probably everyone knows the answer. But guys, do you know where does the word actuary come from? The European Congress of Actuaries, right? So where does the word actuary come from? But I didn't know, by the way. I learned a few days ago.
Something right or
Something about being right or okay.
Yeah.
Any other ideas? Guys, we are in Rome. So the roots of, well, outside Rome, slightly outside Rome. The roots of the profession is actually from the Latin, from the ancient Rome and from the Republican period of ancient Rome. The actuarius were actually those officials in the army that were basically entitled to write down the official script of the generals and of the senators and so on. So they were basically scriba, right? So they were, guys like a little bit of bureaucrats, right? Working on the documents, on the actual documents, like on the official documents. Then, during the imperial time, the actuarius, so after Christ, basically, it became those guys, those officials that were entitled to actually define what was the provision of food, the provision of wheat, that the army, the legions of the Roman army were actually expecting to receive in order to make sure that they had sufficient provision of food, right? So let's say the idea of provisioning starts to arise in the environment, right? But the truth is that actuaries were born as bureaucrats, okay? Now, so after this framing, let's say, I'm not going to talk about myself, but I will mention something about Prima. I'm the Chief Financial Officer at Prima. Prima is the biggest insurtech in Europe. In 2024, we are on track to go beyond the 1.2 billion gross written premium. We are not an insurance company. We are an intermediary. We are an MGA. We have, over 3 million customers, and we are private equity backed. So let's say the guys I need to speak on a weekly basis, at least, are Blackstone, Goldman Sachs, and Carlyle, right? So on one side, let's say we have lower requirements in terms of solvency expectations, right? Because we don't have the macroprudential supervision on Prima itself as an MGA. But on the other side, let's say on a weekly basis, I need to discuss with our, let's say, pretty active investors, let's say. So today, I think during the last 24 hours, we've been talking about, we've been listening to a number of speech alongside two main landscape evolutions that we observed into the insurance industry in the past 10 years, and even more importantly in the last few years. So on one side, the revolution coming from the regulatory wave, coming from first Solvency II and then IFRS. I mean, we have been discussing about IFRS 17. And then the other one is the disrupting impact of machine learning, of AI into insurance, and not only insurance. Now, these two, of course, were great opportunities for us, right? For us as actuaries. It meant basically that technical skills, so IFRS 17 means that in order to close a balance sheet, so the actuarial skills are not only important for pricing and reserving and reinsurance purposes, but they are key in order to define the P&L and the top line as well as the bottom line of an insurance company, right? Solvency II, of course, as we all know, like with ORSA and so on, means that basically you cannot do strategic planning in insurance without a risk view, without a strong quantitative analysis on the strategy that you are pursuing, right? So a great opportunity for actuaries to become the cornerstone, the pillar of the strategy development of an insurance company. On the other side, machine learning meant basically, and also the advances in computational efforts basically meant that quantitative analysis is really a source of competitive advantage for an insurance company. So both of these things, of these two, let's say, waves, would have led an observer to conclude, okay, actuaries are going to be turbo boosted by this flourishing, right? By these two dynamics. However, what we have been observing is that increasingly the regulatory wave of Solvency II and IFRS 17 led our skill set and our focus to be even more and more focused on regulatory-driven, let's say, on compliance-driven dynamics. So we have become the masters of, at first analyzing the quantitative impact studies, then the IOPA guidelines, then the standard formula, then the standard formula evolution, then the internal models, then IFRS 17, the calculation of the risk adjustment, and so on. But really, really, the technical expert on the specificities, right? So here, like the first risk was, that we are observing is the hyper-specialization on technical details. On the other side, we lost, like since Solvency II, for instance, in Italy, we lost, let's say, the regulatory requirement for an insurance company to have their balance sheet signed by an appointed actuary, which is a member of the official actuarial body, right? So it's not required anymore by law, let's say, by default, to be a qualified actuary in order to do that, right? So on one side, you can see already, these two great opportunities actually translating and transforming into a threat. On the other side, machine learning and insurtech and the rises of insurtech actually led to a fierce competition from data scientists, right? I think there have been a few sessions discussing about that. Consider that when I joined Prima, back 5 years ago, I was the first actuary joining that company. So the pricing, the tariff model, were completely performed by data scientists, okay? Prima is just an example, but I'm sure that you are experiencing something similar into your companies, right? The so-called, in the UK, they call it street pricing, right? You have technical pricing, the official pricing that you need to file and so on. And then you have the street commercial pricing, which is even more quantitative sometimes, based on elasticity and so on, but does not look at all at actuarial science, okay? So you can see that these two landscape evolutions are actually translating into a very serious threat for the relevance and existence of actuaries. So what we're going to discuss in the next now 15 minutes, it's it's actuaries of the fifth kind. So we discussed, I think we discussed a few years ago at an Italian actuarial congress about this topic. So we started this session talking about the roots of actuaries, right? The actuarius and the bureaucrat basically writing down official documents. But then, I mean, as we all know, actuaries have developed, and from the 17th century, we talk about the first kind of actuaries, which are the life actuaries, which deploy deterministic models based on observed mortality rates and observed dynamics, right? This is, by the way, a classification which was not invented by myself. It was pulled forward by Buhlmann in the early 90s. He mentioned that actuaries of the second type are casual, mainly P&C actuaries that starts to apply actual probabilistic modeling to insurance pricing. Then in the late 80s, after the Black-Scholes and Merton, let's say, evolution of financial modeling, we talk about the third kind, actuaries of the third kind, which are those actuaries that include and embed a stochastic view also on the life and on the financial side of it, where the risk-neutral valuations start to become very relevant into actuarial literature. In 2005, Professor Embrecht started to, I think it was probably an international actuarial congress, started to talk about actuaries of the fourth kind as, he could foresee the spread of quantitative risk management and of the competitive advantage that actuaries could have into modeling risk for insurance companies, and not only for insurance companies. Well, the opportunities coming from the two waves that we just discussed about the solvency capital, Solvency II, and IFRS 17 on one side, and the fostering of artificial intelligence, machine learning, and insurtech on the other side, actually provide the opportunity for actually to evolve into a sort of fifth kind of actuary, which is specifically a master into data analytics in particular, but that whose skills can also be used not only in order to contribute to the strategy, in order to contribute to the assessment and the quantification of the risk exposure, but that can be actually the setter, the driver, the steerer of the strategy of an insurance company. And actually, the key observation is, guys, it's not possible to develop a strategic plan for an insurance company without actuarial skills. That's clear for everyone, right? I've been, in my past experience, I've been working at BCG for several insurance group, global insurance group, and no CEO, no CFO would have taken any decision without having a full view on the risk-based view of the plan, so on the various scenarios and so on. In order to define what actuaries of the fifth kind, to better specify actuaries of the fifth kind, we're going to talk about three things. So insurtech 2.0. We're going to talk about finance and strategy actuarial driven, let's say, how to define an actuarial based finance and strategy. And then we're going to give a few tips for actuaries in the boardroom. So let's start with insurtech. So if I say insurtech, what example comes into your mind? You're probably thinking either at like small boutiques that maybe provide a solution for I don't know, like anti-fraud in claims management. So small boutique that are maybe into a tiny component of the value chain of insurance, or you're thinking about guys like Lemonade or WeFox, potentially. Maybe some of you are from these companies, that actually had, and let's be very, I mean, we are a small cycle, right? It's a circle here, so we can be blunt, right? The truth is that insurtech 1.0 failed on the promise. Because on one side, user experience, of course, got a very important boost, right? If you go into the website of these guys, they work extremely well. They have super apps and so on. But the reality is that they focus a bit too much on the tech component of insurtech, and they forgot a little bit the insure part. And this is the opportunity for actuaries. So the issue was also within Prima, right? So when I joined Prima in the beginning of 2019, the absence of an actuary for a motor-based insurance player was, I mean, something honestly quite scaring. So this is the opportunity for actually in the context of insurtech, in the transition between insurtech 1.0 and 2.0. So at the end, the idea is really to deploy technology throughout the value chain of insurance. So this is an example on the motor side, right? From the customer acquisition, relationship management, claims management, which was what insurtech 1.0 did pretty well, to be honest. But then the more core insurance components, or risk underwriting, pricing, reserving, risk management, and so on. So that part is actually the core of the insurance business. And this is where probably actuaries have not been as effective into the insurtech wave. So the difference between insurtech 1.0 and 2.0 is driven not only by growth. If you see, so here you see 3 examples, right? So Lemonade and Hippo are US-based. So they're Lemonade. I think Lemonade has a little bit of small portfolio in Europe, but hopefully there is no one from Lemonade and Hippo. I don't know here, so we can talk about them. But on the growth side, the trajectory has been very, very similar, to be honest. The key difference was on the profitability side. So the key difference is that insurtech 2.0 is growing much more than any traditional insurer, while keeping a decent level of profitability. And on the other side, is growing as much as other insurtech player, but with much higher profitability. As you see, like the part that as a CFO I care quite significantly is also the cash burn rate, which is what you see there. Like Lemonade and Hippo raised between $1.2 billion and $1.5 billion historically. Prima raised only 135 million. The problem there, of course, in 2020 and 2021, when the market was super buoyant, super bullish about insurtech, I used to get the challenge, why are you not raising enough capital? Could you, if you were making more losses, you could be actually growing much more. That was a serious challenge that I got from multiple parties. But the reality is that Prima is on a profitable growth trajectory, while Lemonade and Hippo got IPO in 2020 and the beginning of 2021, and now they are worth less than 10% of their peak period. At some point they were worth $7 billion, and now they are in the range of $500 million. Let me look at the time. So when I joined Prima, I tried to think about how to develop an actuarial-driven finance area, and these are the 4 pillars that the prima CFO area is built on. Pillar number one, and there are 4 teams, right, to be very clear. So pillar number 1 is value-based corporate finance. Pillar number 2 is the finance business partners. Third pillar is financial reporting, so valuation and market disclosure. Pillar number 4 is the actuarial and risk analytics view. And this is, I think, personally, the way any insurance company, any CFO area of an insurance company should be built on. Value-based corporate finance means that when I want to set the strategic plan of the company, when I want to push it towards the board, I need to really think and map what are the key building blocks of value creation. We're going to see it, to look at an example, but with a very, very quantitative approach. Otherwise, it's very easy to talk about value creation, can mean anything, right? Second point is to align with the business on a set of North Star metrics so that everyone have the same version of what are the key metrics that I need to look at and what are the triggers triggering corrective actions. Third point, financial reporting. Of course, I need to know what is the value of the company. I need to have a super accurate accounting system. Point number 4 is just the other side, the other view, the more comprehensive view of value, right? Because at the end, all of us are basically Solvency II experts, right, by now. So we all know that valuation is just 1 percentile out of a distribution of a full probability distribution forecast. And another percentile of that distribution forecast is the risk capital, is the required economic capital based on the company's, on the board set risk appetite. So we talked about value creation. So value creation at the end can be measured in terms of total shareholder return. Total shareholder return depends on 2 things. It's very easy, right? So this is a simple algebraic. So it's capital gain plus cash flow distribution. So it's the ability to generate either an increase in valuation for shareholders or to generate cash flows, right? So there is not anything else market consistent embedded value. These are all bullshit compared to this. The point about market consistent embedded value is that actually that is a very effective view to try and basically convert this framework into a single, present value view, right? Capital gains are generated by P&L, of course, by the main KPIs, right? For an insurance company, they can be even book value of equity book value. For an insurtech company, it can be the EBITDA, right? Or the earnings. And then that gets multiplied by the multiple. Now, the multiple is the way according to which the market discounts or overly appreciates the quality of your fundamentals. And this depends on the future dynamics or on the risk view. Of course, there are studies, unfortunately not performed by actuaries, that try to actually fit GLMs on the multiples to define what are the key drivers impacting the multiples on the market. And then, of course, on the ability to generate cash flows, dividends, buybacks, and so on, it's, I think it's quite self-explanatory. You can go even much more in detail, right? So if you take the P&L KPI, one of the target KPI that you can define is EBITDA. EBITDA, then you can, so this is the example for Prima, right? So we have a framework to basically destructure what are the drivers for EBITDA. And this is actually, these are the building blocks of our plan, right? So on one side, you have the first block is the top line, which is driven by GWP and number of contracts. And then you have a different, let's say, strategy on the motor side, on the non-motor side, and then channel by channel. Then you have the technical performance component, the loss ratio, and therefore all the quantitative analysis developed by our actuarial team. And then you have the cost model. So at the end, this is a super simple framework that you can very easily communicate to the board, align with the board on how you want to steer the company, so that the board is fully aware and has, feels like they are actually steering the strategy of the company. And then, as the top management, you can then cascade what does this mean actively for all the different components of the business. An example of how defining the right target metric is a key way in order to be successful in the market is driven by the experience that Prima had on related to the COVID period and then the inflation period. This purple line represents the market share in terms of new business. So out of 100 customers, new customers that were maybe switching or churning from a company to another, this tells you how many people chose Prima. It means that at the beginning, so when I joined Prima, we had 16% of the new business market share online. Of course, this is online. Online is roughly 15% of the Italian market. So it's still a reasonably small market, right, let's say, right? Which is still growing. But out of that new business pot, you can see that, over time, we increased our market share. And the big jump came actually in 2020 during the COVID disruption, because we were the first one reflecting into our models, at least in the Italian market, we were the first one reflecting the fact that, of course, with the lockdown, claims frequency was dropping to super low levels, right? On the other side, we realized in 2022 that there were two new nuances, right? So news number one, there was no COVID anymore. News number two, the disrupting impact of inflation, of expected inflation. Because some of you might say, in 2022, of course, there was CPI inflation in the real economy, but not too much on the claim side. Not yet, let's say. But the fact that you are, so in 2022, in the second half of 2022, we were writing policies that would have been exposed until 23, and whose claims would have been paid are potentially even they are still being paid, right? So in 2022, we realized that we needed to actually reflect the changed expectations in inflation for the next 3-4 years. So from 0 to 2% inflation to 10 to 13% inflation that we observed in Italy, of course, the impact was huge. Our UK colleagues saw it even more significantly. So what we did is super drastic, a drastic decrease in our market share. So which means we are increasing prices, right? So you see that it's super important to align on a framework like this in order to convince the board that that drop was the best news that I could deliver to the board in late 2022. Because it meant that the rest of the market was probably gaining back our market share, which was an unprofitable, unprofitable actually, based on a price that was not coherent with the new macroeconomic environment. Then, when we finalized the pricing review in January 2023, and from that, basically that enabled us to be already profitable in January 2023 in terms of new risk, new policyholders, new contracts. And that spike in new business is actually the market reaction that, with a delay of 9 months, started to increase prices in Italy. So it's super, super key to be aligned with the board. Otherwise, no way that you're really going to make it. Yeah, I mean, of course, we did huge investments into actuarial work streams. There are 3 people here that developed from scratch as far as I know, the most advanced model for claims reserving on a claim-by-claim basis. So it's based on a Bayesian network modeling. So basically, machine learning applied to reserving. We got a tech team focused on serving the finance and actuarial team, which is 4 or 5 developers, but that every day are just focused on automating our data flows and making sure that our data quality is there. Maybe very, very final point, a few tips, 3 tips for actuaries in the boardroom is, I would say, let's keep this one. So tip number 1 is about the pyramid principle. I think as actuaries, we are usually tempted to, let's say, boil the ocean a little bit. So when you get a question from the board, we really struggle to even understand the question, right? Because it's too broad, and it's coming from someone who clearly doesn't have the technical background. And therefore, you start deep diving into the assumption of your analysis, and the board is lost after half minute. So the pyramid principle means starting from the main message, and then go down into the building block. A little bit like we did with the metric, right? So our business plan is not based on assumption. It's based on that tree. And then, of course, if you go down from the BDA to the various components, then at the end, you arrive into the detailed assumption. Outside the comfort zone, we need to be ready to to recognize that we are not anymore the expert in the room. We are not the guru. We have a powerful method in order to address problems, but we do not necessarily have the answer because we know it. And this is super uncomfortable, especially for an actuary that studied several years in order to be the expert in the room. This is our target, right? But and this is a picture of, I think, the most important actuary, maybe together with Giuseppe Ottaviani, potentially, the most important Italian actuary in the 20th century, Bruno De Finetti, that was actually calling out to avoid that laziness that consists into considering a universal truth just because in the past you have been successful in doing something, right? So you really, really need to reinvent yourself if you want to stay relevant. Of course, I mean, it's clear, right? So many of you, almost all of you, are managing teams and are training young actuaries. Super important to start to train them to focus not really just on the modeling work, which is, of course, the core skills, right? The core skill set of an actuary, but really to think about 2 things. The framing, so how you frame overall, so let's maximize profitability. Maximize profitability is a super useful thing, right? So we need to frame how do you think about this problem. And then second focus is on the communication, the story, engineering, and think about how to think about the story. So final remark, if we want to try not to be just the bureaucrat that we used to be as actuarius in the ancient Rome, we really should try to get a little bit out of the comfort zone and be even a bit more ambitious by defining clear objectives and be super disciplined in trying to maximize and explain to the board and to the senior stakeholders how to maximize them. Thank you.
Thank you so much. We made it almost on time. A single question or 2? One there. You need to go to the mic. Yeah.
So, if you do a rough estimation of, if you take the top 10 insurance companies in Europe, no, and you do a rough estimation of the number of actuaries sitting in the board of these top 10, it's more or less roughly 2.5%. So we have 3 actuaries over 116 board members of the top 10 insurance companies. Do you think that is just a consequence of the missing pieces that we have in our story, or I don't know?
I really believe into the self-realization of expectation. If we are trained and we think about the fact that our model is to really become the expert in the room, you will be the expert in the room. So you will be, if you are a good actuary, you will present to the board. You might present even effectively, even solutions, not only problems, but you will not be part of the board, right? So I think it's important. That's why the focus is on thinking about on spelling out what are the objectives, not only of the insurance company, but also the objective of your career, in my opinion. And then, realizing those objectives will just follow, will just be easy execution.
Sounds easy. Okay. Thank you so much. I think,
Thank you.
Given the time, we'll just stop here. Thank you so much again.